Hello, this is a video where I'm going to talk to you about how to use a discounted cash flow approach to estimate the market value of equity for a firm. Um, Again, this is a little bit of a theoretical approach. I'm going to apologize in advance. This video is probably a little longer than some of the other examples because I do need to go back and sort of tie it more to things that you've done in the past, but bear with me. So, quick review. If you remember your time value of money, present value information, you know that the present value of a stream of future cash flows is the sum of each cash flow discounted back at an appropriate discount rate for an amount that represents how far out into the future that cash flow is. So you're going to do that with each cash flow and then sum all of those back, and that's the present value. And while you may not have heard it said that way, you want to make sure you're clear that the present value of a stream of cash flows is the price that a willing buyer and seller should agree to transact at, assuming that they both agree on all of the assumptions for the inputs. And you'll see here in a little while that not everything is always known to the public and agreed on between everybody, and so that may cause the two not to exactly agree on price. If we were to convert this into a thought for market value of equity, then we ought to be able to say that the market value of equity, which I'm going to designate as this V little e of a company's stock, should be the present value of the cash flows that equity investors expect to receive from holding the stock. So again, I've not done anything to the formula other than say that this should work for value of equity. And when we use this technique, this present value technique for stock, it's sometimes referred to as the discounted cash flow approach to valuing a thing, and in this case of valuing a stock, because you're simply taking the cash flows and discounting them and summing them up. So if you look at the formula, you'll see that in order to apply that discounted cash flow or DCF approach, you would need an estimate of the relevant cash flows. So you need to define them. What do we mean by relevant cash flows? You need to develop an estimate of those cash flows into the future, right, over the life of the stock. And then you need to figure out an appropriate discount rate. And that's what I'm going to show you how we would normally do for a company. I'm going to give you an example of that in this video. So the company I'm working on is Disney. And the first thing that we want to do with Disney is we want to figure out what the appropriate cash flows are. Well, the appropriate cash flows to use for equity would be the cash flows to which equity owners are entitled. And that concept is usually referred to as free cash flows to equity. Now, you can go Google that if you want to. You'll see that if you were to go out and Google, for example, free cash flows to equity, you'll find all kinds of good information, defines it, explains it, all sorts of stuff, chapters and books. So there's a huge amount of information out there about free cash flows to equity and using them in a discount model to value companies. And so just want to point out to you that if either my explanation's not enough or the book's not enough, or you just want to learn a little bit more about them, there's quite a bit of information out there. The concept of free cash flow to equity is fairly straightforward. It is what, in any one period, what cash flows would go to equity. And so we would start with net income and say that, looking in terms of future cash flows that go to equity, we'd start with the net income of the company. We would add back non-cash charges. We would do that because they're not cash. And so similar kind of thing you've done with net present value, you're going to add back depreciation, amortization. You're going to deduct change in working capital, investments, change in working capital, because both of those generally reflect outflows. Now, you could get negative numbers here, meaning what happens if maybe I didn't invest in anything, but I sold off some of my investments. So you would deduct a negative, which would mean you'd add it. So minus a negative is positive. And then you'd add back any net borrowing. Conceptually, when a firm borrows money, the view from an equity owner standpoint is that it's actually the equity owners borrowing the money because they have to authorize that it can happen, and using that money to give to the firm to invest in things or do whatever with. But technically, that is the equity owner's money until such time as it has to be paid back as principal. I have put together a completely separate video that goes into detail about with Disney, sorry about that, where I get these numbers, and, using their financial statements and calculate it. But the result when I do that for Disney was $10.617 billion. That's for their fiscal year ending October 1st, 2016. I would encourage you to watch that video for details. At some point, you're going to want to know how to do free cash flows to equity. You don't need it to answer this prompt in class, for example. You don't need to go through and do a full calculation. You can just make sort of a simple look. Let's just assume free cash flows to equity or some amount. But at some point, you're going to want to know that when we really start digging into it. Second thing you're going to want to know is the discount rate, as we talked about. The appropriate discount rate to use is the cost of equity, which is sometimes known as the required returned equity. And so we use the capital asset pricing model for that. And again, we will spend a little bit more time on the CAPM in the class, but for now I just want to explain that's where that capital asset pricing model is most frequently used, is for this kind of evaluation. And so for Disney, well, the capital asset pricing model simply says that the return, the required return for equity is equal to the risk-free rate plus the beta of the company times the market premium. And the market premium is just the required return or expected return from the market minus the risk-free rate. And you'll see I've also put together a separate video on where I get all of these numbers for Disney. You don't have to know that for this prompt, but at some point you're going to want to know that, and that's a good resource. So first thing we get is the risk-free rate. The risk-free rate, we usually use the 5-year Treasury yield rate in CAPM. It's a tricky thing. Technically, theoretically, the capital asset pricing model risk-free rate should be the rate that investors expect, should use a term that is the same as the length of time investors are expected to hold the stock. But no two investors are expecting to hold it for the same length of time, and some of them don't even know how long. But if you think in terms of some will hold it for very short periods of time, some for very long periods of time, the 5-year Treasury yield is a good proxy for that. And again, on the video, I show you where you can get the Treasury yield. At the time of this video, for the 5-year, it was 1.9%. Same thing, you need a beta for the company. Now, we'll talk at some other point about how you go about calculating a beta, though I don't think in this class that I'll ever have you actually go calculate them, because, quite frankly, the number you come up with will be different from the number that you might see in other places for a whole bunch of reasons. But luckily for us, there are firms that calculate in theoretically correct ways the beta for firms and publish them. And one of those is Yahoo Finance. They show a beta for Disney of 1.44. Remember that a 1.44 for a capital asset pricing model beta means that Disney's a little bit riskier than a typical stock in the market. The return, and again I show this in the other video, on the S&P over the last 10 years has been approximately 4.97%. And so that number we use. And the return to equity implied by all of that, so this return on equity from CAPM, if you just plug in the numbers and calculate, is 6.32%. So we would use a 6.32% discount rate. Now, still need the future cash flows. one of the most common things that people do in terms of future cash flows is they just take whatever the current cash flow is and then assume that it'll grow at some constant rate into the future. It's convenient and mathematically easy to handle, but we still don't know what that growth rate would be. And there's generally not a lot of good sources for it. You can go look out sometimes if you were to look out, for example, at analyst information. They may have some estimates of earnings or revenues, future revenues, or whatever else, earnings per share. But again, what you would have to do is sort of take some implication of, oh, they were this much this time and they're going to be that much next time. And you can see that not all of the numbers are going to give you the same sort of result. And so, for example, if we took earnings estimates, this one suggests that earnings from current year to next year are going to grow, and they maybe are going to grow by about 10%. If we took revenues, revenues aren't going to grow by nearly that rate. You see here, if we took the earnings per share estimates for the current year versus the next year, those are, well, actually that's not current year versus next year, I guess. So you see what's actually happened is they've gone up. They had an actual, then it went down, then it went up, then it went down. And so it's hard from that to sort of pick up a trend and say, well, what do we think the earnings per share will be? The trend, current quarter, next quarter, current year, next year, these are sort of giving you an idea of what people think. And again, I guess they think a growth rate of about 10% makes sense. But once again, that's in earnings, that's not in free cash flows. So not sure exactly how that should be translated. Here's some growth estimates. They were, current year, they were 3.7. They're projecting 12.10 for the next year. 10% for the next 5 years. That sort of thing. Now that's per year. So you do have some of those estimates out there. However, I think when you plug all of that in, you're going to find that maybe doesn't make sense. So one of the things that we can do, though, and this is one of the reasons why we have theoretical models, is we may not be able to observe every value, but if we can observe enough values, we can solve for the other ones. And so in our case, if we convert, remember we talked about using just a single cash flow and then assuming some growth rate. Well, that makes this discounted cash flow formula a growing perpetuity. Again, you should have seen that in your time value studies. If not, you can refer back to the text on time value and see about a perpetuity. Or you can go out and Google a formula or an explanation for a growing perpetuity. But what that would basically say in our context is that the value is whatever the next cash flow is divided by the discount rate minus some growth rate. Well, guess what? We know what the current value is. We have that. It's the market cap of Disney. We know what today's cash flow is. And if we take today's times 1 plus the 1 year growth rate, we would get next time's. We have a discount rate. So we have everything except for G. We could just solve for G. So I'm going to show you how to do that. Drag this spreadsheet over real quick, which I've built for this purpose. Again, we know that the market cap is 172 billion. How do I know that? I can go over to the summary information for Disney. Market cap 171.97 billion. The rounding's not going to matter that much, but let's just call it 172 billion. The free cash flows today we have calculated as 10.617 billion. You can see that in the workbook, and you can find out how I did that in the other video. Discount rate 6.32%. So just using this formula, I'm going to start out with what I'd call an implied growth rate, or G. And I can just put a number in there. Let's call it 5%. Okay? It's just a placeholder right now. I'm going to show you how we're going to figure out what the right value for that is. We're going to plug in the 172 billion, which I'm just reading from above. Plug in the free cash flows, which I've just read from above. Need to calculate the cash flow 1 year from now. The free cash flow is 1 year from now. The reason we need to do that is that the perpetuity formula, if you remember, assumes that we're going to get a cash flow at the end of each year. And what we've got is a number as of today, so we need to get what would the number be a year from now, assuming some growth rate. So it's just the free cash flows today times, or the most recent ones that we have, times 1 plus the growth rate. Okay. We've got our discount rate in here. And so using all of those inputs, we can calculate what the implied value or market cap is. Okay, and at 5%, that implied market cap is 843 billion. That sounds way too high. So what we need to do is we need to figure out what value of G will make sense. Well, if it's too high, it probably means that our growth rate's too high. So let's drop it down to 4%, and that gets us closer. You can see I have a little difference calculator down here. When it was at 5%, it says, oh, you're $671 billion off. 4%, you're $300 billion off. 3%, $150 billion off. 2%, $78 billion off. 1%, $29 billion off. Well, you can keep trial and erroring this all you want, but there's actually a simple built-in feature in Excel that'll help you get right to it. Go under the data menu, and it's under the what if analysis. It's called goal seek. Goal seek says, tell me if I want to set a particular value cell, in this case we'll do this difference, to 0. I'm setting it to 0 because I want the difference between my implied value and my actual value of the stock, or of the markets, the market cap. I want that difference to be 0, and I'm going to do that by changing the implied growth rate. So I go through and do that, and it says, oh, the growth rate is 0.14%. So that's nice to know, and we can record that, and you can see we use all of that, we get to the 0.14. So pretty simple way of getting that. But that's sort of a roundabout way. It would be nice to know how sensitive the market cap values are to some of these assumptions. And so over here, I've basically created a sensitivity analysis. And you'll see under the G, I've just said it's equal to whatever it was before plus whatever I put in this change column. This is just equal to that. This is just equal to that. This is just equal to that. Technically, I didn't do it as equal to that. I did it as equal to the formula this times the growth rate, because if we change the growth rate, we change this. So I can't just set it equal to what it was over there, because when I change the growth rate, I want it to change. This, again, that's something we'll do a sensitivity on, because you can't observe it directly. And so we're going to look at that and say, oh, 6.32%. Plus whatever my change is. And the implied value is, again, the same formula that I use over here. It's just, I got to put it over here and use all of this information. And then here's your difference. And so let's just say that we're off by 1/10%. That's going to make the, sorry, not 10%, let's go 0.001, 1/10%. That's going to make our difference we're going to be off by about $3 billion. On a per share basis, I had gone to Google and seen that they had 1.59 billion shares. So on a per share basis, we'd be off by a little less than $2. Now, if I did minus that instead of plus, we'll still be off by a little less. It's a little bit different either way. So we'll put that back to 0. Let's make this one 0.001. So when we change the discount rate, we're also off by a little less than $2. It doesn't matter much if I go minus or plus. Okay, changes it a little bit, but not a whole lot. Now, here's an interesting thing. If we're off by 1, let's say that we overestimated the discount rate, and it should be 0.1% lower, but we underestimated the growth rate, and it should be 0.1%. Right? Sorry, 0.001. I do that right? Yeah. Okay, so if I overestimate, or if I underestimated both of them, they offset each other, and there's hardly any difference. Similarly, if I do 0.001, 0.001, and I overestimate them, there's hardly any difference. So they got to go in the opposite directions. If I miss on both of them, and I miss in the opposite direction on each of them, that's going to cause a bigger impact. So let's just say I make that one positive and that one negative. Now I'm looking at being off by almost $4. So it's not enough to just know, oh, if I miss by one or the other, think about the combinations. But in the grand scheme of things, sorry, I'm going to flip back to that. In the grand scheme of things, you're talking about being off by $4 on a $108 stock. And so kind of a big deal, might cause you to say, hey, I'm a little over or undervalued. But certainly, if you wanted to get sort of an approximate value of a company, and one guy said, hey, I think it's $104, and the other guy said, I think it's $112, most people would look at that and say, wow, that's a pretty narrow range for the value of the company. So in that sense, this does a pretty good job, provided you can get a reasonable estimate of these things. Now, don't know if you recall, but the Yahoo estimate said that they thought that the 5-year growth rate was going to be about 10%. If I put in 10% on this company, using everything else in there that we know, it winds up saying that the market cap is way undervalued. The stock should be $307 a share. So right off the bat, that tells us that there's either something wrong with that estimate, maybe it's only in the short term and then things flatten out or go to 0. That's another of the weaknesses, if you will, of this model, is you have to know the growth rate for the entire life forever, not just for the next little while. So let's see, we already did that sensitivity analysis. So just real quickly, want to highlight the issues and insights from this model, why we use it. The issues, we must either have a forecast of free cash flows to equity in the future, or we have to make a growth rate assumption. And either way, we're making an assumption. And also, we can't observe either the growth rate or the discount rate. We have to go estimate those from other things. And so, in some sense, it's sort of one of these where if I had some additional information, I could solve for the fair value or explain the fair value, but I don't have that information, and so sometimes hard to use this method to really hone in on the value of a stock. However, it does give you some insights. Remember, the important thing about theoretical models isn't just whether they allow you to calculate a number that you think is a good, is representative of what the world is like. Sometimes it's about pointing out to you what kinds of things should add value. So the discounted cash flow approach does highlight certain financial decision-making principles. The value of the firm is simply the present value of all the future free cash flows to equity of the firm, discounted back at the fair return to equity. You can break that into its pieces, because the free cash flow to equity of a firm is just the sum of the free cash flow to equity of all the different businesses or investment decisions or whatever else of the firm. And so you could look at projects that have free cash flows to equity. You could use this discount rate model on each project. And if the result is a positive value, then the project adds that much value to the overall equity value of the firm. And in fact, that insight is what has led to the net present value approach that we use in making investment decisions. So it's a nice insight, and this is the way financial theory works, is you have to start with sort of basic principles, and then from that you can get to maybe different approaches that don't have to take you all the way back to something like free cash flows. A couple of other insights. These are less about the decision-making inside of the firm, but just generally how to think about value for one firm versus another maybe. Firms with a greater free cash flow to equity will have a greater value of equity, all other things being equal. So greater can be greater in the short term, greater in the long term, greater both. But if they're the same at some points and greater at others, then it'll be worth more. Firms that have a lower cost of equity will have a greater value of equity. So the lower the discount rate, the higher the value of the firm. Since discount rate, as we know, is tied to the riskiness of firms and to their beta, as an example, when firms have lower betas, they are more valuable. When they have higher betas, they are less valuable. Similarly, when the overall discount rates go up and down, maybe because interest rates in the market go up and down, that'll affect the value of firms. And so, for example, right now, we're getting ready to, we believe that the Fed is getting ready to start increasing interest rates over the next year or two at a moderate pace. Every time that they increase the Treasury rate, remember that's added to the rates in the cap-M because it's risk-free rate plus whatever. And so whenever they increase those Treasury rates, that's going to cause the discount rate for all companies to go up. So if their cost of equity goes up, what's going to happen to the value of those firms? And if it happens to the value of all firms, what's likely to happen, unless something else comes about as well, what's likely to happen to the value of stocks? So this is one of the limiting factors on stocks right now is that people are worried that when the Fed starts increasing interest rates, that it's going to cause all of the stocks to lose value. And then the last thing is the higher the growth rate in free cash flows, the greater the value of equity, all other things being equal. So again, sort of a common sense result. Anyway, that's all there is to discounted cash flows approach. Again, it's a very fundamental based approach. And this is the approach that most directly ties back to that principle related to present value of things. And so I apologize for this being a little bit longer, but it was really about connecting some dots for you. Thank you.